Hi all, welcome to my channel Satish Vlogs. In this video, I would be explaining the concept of writing of bad debt. What is this writing of bad debt all about? What are the journal entries when the bad debts are written off? How this writing of bad debt should get reported in financial statements? All these details I would be explaining in this video. With this introduction, let's move to the next slide of my PPT. In this slide, there is a diagram which depicts like a cycle. This is nothing but an accounting cycle. What is an accounting cycle? What are the various phases of an accounting cycle? All those details I had already provided in my previous video on accounting cycle. And also, this writing of bad debt is an extension to my previous video, which is video number 13. Okay, and the video is related to the provision for doubtful debts. I request the viewers to go through those two videos before getting into the details of the current video in order to gain better understanding of the current concept on writing of bad debts. And I would be providing the links for those two videos in the below box. Okay, and as mentioned previously, I would be explaining my concepts considering the phases of an accounting cycle. As part of the first phase of an accounting cycle, which is business transaction, the business transaction is writing of bad debt. This writing of bad debt is nothing but the recognizing the bad debt as an expense, which means the actual bad debts are being erased in the business organization. Then in such a case, what are the journal entries which are supposed to be posted, how this should get reflected in the financial statements, I'll go through as part of the next phases of an accounting cycle. Okay, in my previous video I had clearly mentioned that my business organization had sold goods to Mr. A on 1st of Jan, which is due to be receivable on 30th of June, right? However, it is understood on 31st of March, which is the date of the preparation of the financial statements. On that date, it is understood that there is a probable default might happen regarding the amount which is supposed to be receivable from Mr. A. Then in such a case, what we had done, we had created a provision for the amount which is supposed to be receivable, right? So when the provision was created, we had expensed the bad debt expense and we had created the provision, but we didn't directly adjust the bad debt expense or provision against the sundry debtors, right? So in this video, I would be explaining you how that adjustment needs to be done against sundry debtors. Sorry. Now with this, I hope it is clear regarding business transaction. Now let's move to the next phase of an accounting cycle, which is journalizing phase. What is this phase all about? Whatever the business transaction for which we need to record the journal entries, right? So what is a journal entry? When the bad debts are actually recorded or erased. See, when the bad debts are actually erased, we are supposed to reduce our sundry debtors because we are not going to receive the money from the sundry debtors to the extent of the bad debts, right? So for that purpose, we are supposed to reduce our sundry debtors. Sundry debtors is a personal account, right? So when the amount which we are supposed to be receivable, normally we will debit our sundry debtors, right? Because what is the golden rule for a personal account? Debit the receiver, credit the giver, right? However, as the bad debts are erased, then in such a case that sundry debtors needs to be reduced to the extent of the bad debts. So what we are supposed to do, we need to reduce our sundry debtors. So instead of debiting, we should credit our sundry debtors, right? So the credit needs to be given to two sundry debtors. Now to which account we are supposed to debit? We shouldn't debit the expense account now, because we had already created a provision in the past, and the provision is currently parked in a provision for doubtful debts account, which is under the current liabilities, right? Now we need to reduce our current liability to that extent, right? So whatever the amount which has been parked in provision for doubtful debts, which is under current liabilities, that needs to be reversed out, right? So the debit needs to be given to provision for doubtful debts or provision for bad debts. So the entry is provision for bad debts account debtor to sundry debtors account, right? Hope this is clear. Now let's move to the third phase of an accounting cycle, which is a ledger postings phase or ledger creation phase. What is this phase all about? For whatever the journal entries which were posted as part of generalizing phase, for which the ledger accounts are supposed to be created, and the entries are required to be posted in the respective journal, in the respective ledger accounts, right? So what were the entries which were posted as part of generalizing phase? One is the provision for doubtful debts account, and the other one is the sundry debtors account, right? So the entries for these, the accounts for these entries are supposed to be created as part of ledger account phase, ledger creation phase, and the entries are required to be posted accordingly. Hope this is clear. Now let's move to the fourth phase of an accounting cycle, which is a trial balance phase. What is this phase all about? Whatever the ledger accounts which were being created as part of ledger posting phase, the balances for those accounts are required to be updated, right? So the balances for the provision for doubtful debts and the sundry debtors are required to be updated in trial balance phase. Okay, so the debits, ideally the debit should matches up with the credit balances, because as we have been following double entry system of bookkeeping, there shouldn't be any discrepancy. Okay, hope this is clear. Now let's move to the last phase of an accounting cycle, which is financial statements phase. What are the critical elements of a financial statements? One is the income statement and the other one is the balance sheet. As mentioned or as stated, this entry doesn't impact my income statement, because this entry directly hit my balance sheet. To which accounts this will directly hit? One is the sundry debtors and other one is the provision for doubtful debts, right? So the balances for those two accounts are required to be updated accordingly in the balance sheet, and the balance sheet should get matches up, because as we have been following double entry system of bookkeeping, and the balances we will update directly taking the amounts from the trial balance. With this, I hope the viewers are able to understand what is this writing of bad debt all about, how this needs to be taken place, what are the journal entries when the bad debts are written off, how this should get reported in the financial statements, all these details. Okay, if the viewers like this video, request you to like it, share it to your friends, and subscribe my channel for more videos. Thanks for watching. Catch you in the next video.